Good morning, this is Mark Boud of Real Estate Economics. Welcome to our webinar series. It is April 6th, 2011. This morning's topic is economic and housing market trends and forecasts for the state of Texas. We follow four of the major metropolitan areas within the state of Texas, and we combine all of them in order to produce what we think is a meaningful analysis, trends, and forecasts for the entire state. I'm going to do this webinar a little bit differently in that I won't necessarily be showing a lot of slides. Instead, I want to go directly to our website. So I'm going to do that right now. Those of you who are unfamiliar with realestateeconomics.com, here's the home page of our website where we offer online information tools, real estate tools for a 14-state region. This morning I'm going to go right into products, show you some of those products that we offer for the state of Texas, and pull up some tables that will allow us to analyze that market and show us what's going on right now. The first one deals with a housing transaction report. Every month we download every single transaction that occurs within the four major metropolitan areas that we cover in Texas, and we analyze those in terms of foreclosures, foreclosure sales, traditional resales, and new home builder closings. We'll go and from the menu choose all of the areas that we have in Texas. And from those various counties, we'll then choose all of the cities, and then within each one of those cities, we'll choose the entire list of zip codes. So you can actually go down from the county level to the city level to the zip code level, and you can actually even choose polygons from there in order to get as small an analysis as you'd like. In this case, we're going to choose just the month of February for that entire four metropolitan area region that we cover. Okay, here you can see the map that shows every transaction that has occurred in this four region area: Dallas, Greater Dallas area, the Houston area, Austin, and San Antonio. If you actually zoom into these areas, which you can do with our mapping software, you can see the detail of what's going on. The color coding is as follows. The traditional blue dots are the traditional resales that have occurred during the past month. The red dots are new home builder closings. The orange dots or yellow dots are foreclosure sales, properties being sold from the lender to a new owner. And the red dots are foreclosures. Here's the pie chart that corresponds with that, various market shares that have occurred. You'll also just show quickly on our mapping software the capabilities of it in terms of going into a given area and selecting aerial photos. You can copy these onto your presentations, really get an idea on the ground level as to what's going on in a given market area or a given master plan in terms of transactions. Okay, enough of that. I'm actually going to run the report. Once I do run the report, then it goes into a vault area where your particular reports are stored for those subscribers subscribe to our services, and we'll go ahead and pull up that report from here. Looks like this. Housing transactions report for those four major metropolitan areas that I identified for the month of February. There were a total of 11,166 transactions that occurred during February of 2011. That's a lot, but it's 34% lower than what occurred during the same period a year ago, and about 37% lower than what occurred 2 years ago. So we're losing sales volume. That's not a good sign. We track sales volume carefully, because if sales volume dips, here you can see it graphically in terms of single family versus condominium sales volume. If that dips significantly, then it slows the amount of equity that rolls over into the next transaction, and it weakens the overall price support. And so the very first sign that we see is not a good sign. That's partly a reflection of tightened lending. It's also actually partly due to a reduced level of distressed transactions, which I'll explain in just a bit. Overall prices, the actual average prices increased by 3.8% during the past 12 months, and it's higher than it was 24 months ago as well. The overall price or unit size has increased slightly. Price per square foot has dipped slightly. So there may have been some marginal depreciation in this area. In other words, that 3.8% gain can't necessarily be attributed to appreciation because you've seen a corresponding increase in the overall unit size. Here you can see the overall transactions broken out by type, by resale, new home builder closings, foreclosures, and foreclosure sales. Couple things to note: resale volume has fallen significantly during the past 12 months. That's not a good sign, as has new home builder volume. But foreclosures have as well, as have foreclosure sales. The fact that foreclosure sales are lower than foreclosures is a worrisome sign. It means that we're actually building distressed inventory in this area. I'll talk a little bit more about that a bit later. Just to show you some of the charts that are included in this particular report, I'm going to do a preview so you can see those charts. One chart covers price and price per square foot trends, volume trends, an overall scatter chart, mortgage trends. This one shows transactions by type, whether they be resales, new home builder closings, foreclosures, or foreclosure sales, and then a distribution of transactions by price range. All of that is included in the housing transactions report, as well as several other sheets which really effectively describe what's going on in this market area, graphically as well as in a tabular format, and even to the point where it allows you to implement data so that you can do your own competitive comparisons. I will state that we deliver our information in a Microsoft Excel or Microsoft Word format because we want you to use this information. To me, it doesn't do much good to offer it in a PDF format where you really can't play with the numbers. We want you to use this information and be able to take these numbers and apply them to your own methodologies. Okay, let's actually go back to the website. And the next one I'm going to cover is the Residential Economic Report. And that's also shown on our website. Part of what we're doing, part of the purpose of doing this particular webinar is to expose the Texas market to our Residential Economic Report. We're actually offering a free short trial subscription to both the Housing Transactions Report as well as the Residential Economic Report. And you can go to that various place in the vault. You can see all of the areas throughout the nation where we cover for the Residential Economic Report. I'm actually going to call up the State of Texas Residential Economic Report. I put it in a PDF format for convenience sake, though it's actually delivered in both a Word format and a PDF format, just to give you an idea as to what the overall what's included in this particular report by going to the table of contents. We cover statewide housing market trends as well as comparative market price lines for the new home builder market price line relative to the resale price line relative to distressed housing. And then we give statewide economic and housing market forecasts regarding employment, housing construction, housing prices, price trends and forecasts, mortgage rate trends and forecasts, household income demographic trends, and so on. We combine all of that information into a housing supply and demand model, which gives you an idea as to where the overall market is in terms of housing supply relative to what is being demanded. And then it gives you another part of the model which shares with you the overall price support. It's more of an affordability level to give you an idea as to what overall price appreciation potential there is in the future. We're going to go to that model now and just share with you briefly the result of all of the forecasts that are presented in this model. Page down to that. Here it starts right here. And I'm going to shrink this down a little bit so we can actually see it a little bit more clearly. Okay, statewide housing supply and demand and over-under valuation patterns for the next 5 years. It starts with a table that gives an overall measure of jobs, of housing supply, and then housing demand. Housing supply is simply a function of construction. It's benchmarked to the census every 10 years, and we use permit data in that benchmarking. And then housing demand is a function of economic growth or loss. So housing demand can actually go up and down, whereas housing supply doesn't necessarily go down. It slows during recessionary periods, but it's never really a loss never really is incurred in terms of housing supply. Where there are gaps between the two, you either get a period of over supply or undersupply based upon how the economy is doing relative to overall housing supply. Let me show this graphically. It shows it a bit more clearly. The green curve that you see is our measure of overall housing demand. You can see in the state of Texas right now, at least in those major metropolitan areas that we identified, there's about 9.5 million homes in the ground. In terms of what's being supplied, there's probably about 9.6, 9.7 houses actually in the ground. The difference between the two is oversupply. Almost every market throughout the United States is oversupplied right now. Texas is one of the least oversupplied markets. Here's the difference between those two curves graphically on the residential economic report. If it's below the equilibrium line, it's oversupplied. If it's above it, it's undersupplied. Here we've entered into a period of oversupply, which is typical given the recession that we've gone through. We're heading back toward equilibrium, but it's going to take a couple years to do that. We think that we'll actually exceed equilibrium and enter into another cycle of undersupply by about latter part of 2013 into 2014. So it's oversupplied right now. That promotes market or price weakness, but it's not nearly as oversupplied as a lot of other markets throughout the United States. You can actually do well in an oversupplied market if you're also undervalued. Now let me share with you the overall trends in terms of undervaluation. Like I did with demand and supply, I think I'll show you that graphically. The blue curve is where median prices have been for homes throughout this 4-region area. The green curve is where I think prices should be based upon overall affordability. And what goes into that affordability is household income, mortgage rates. You can see this big run up in affordability based upon drops in mortgage rates, as well as other factors, equity wealth, equity rollover, and so on. When there's a gap between the two, which is a pretty significant gap right now, in this case it spells undervaluation. When the blue curve is above the green curve, it actually spells periods of overvaluation. Here's a chart that shows the difference between those two graphs. What I wanted to point out is that never have these Texas markets been more undervalued than they are right now. That's partly a function of the financial crisis. When lending stopped, housing prices fell in value, even when it wasn't necessarily justified by the condition of the economy, at least not in Texas, and that undervaluation became increasingly manifest and has really peaked during the past couple of months and will continue at a very, very high level during the next few months. What this means is that based upon fixed mortgage rates right now, based upon prices right now, and the condition of the economy in Texas, never has there been a better opportunity to purchase a home or more upside as time goes on. As time goes on, this will slide back down to equilibrium. It will do that with a combination of an increase in mortgage rates as well as an increase in price. There has to be price appreciation in order to force that back. Then we think we'll actually go into a cycle of overvaluation by 2014, 2015. When you combine these two portions of the overall market into a model, in a tabular format, it looks like this. Here are our patterns of overbuilding and underbuilding in Texas, as well as our patterns of overvaluation and undervaluation. We've weighted both of these categories to come up with a composite index of leading indicators. I call it the opportunity risk index. It tends to lead the market on average by about 24 months. Because of the severity of the current recession, that lead time has increased by about 36 months. What it means is that the relatively weak indexes below 100 that formed during 2006, 2007 really became manifest in 2009, 2010. The strong index, a relatively strong index that formed in 2011 that is forming right now, we think that that doesn't really manifest itself in the market until about 2013, even 2014. Overall, though, this index has remained fairly stable. Not so with most California markets or Arizona or Nevada. This is highly different than most other places in the nation where you have generated some gyrations in the index, but it's been far more stable than most other markets, creating just a little bit of weakness or a little bit of strength, but overall it's remained stable. Graphically, let me get to the table that shows that index. Bear with me while there we go. Graphically, it looks like this, where that thick blue line is the overall composite index, the dotted green line is the mortgage to cost index, the dotted blue line is the jobs to housing index. Overall, it spells a continued stable market, especially with the job growth that you are seeing in Texas right now. I'll end by just touching on what that job growth looks like. And okay, current job growth by industry right now looks like this. And what's amazing is out of the 11 major industries that represent overall jobs in this area, only 2 of them are negative right now, information and construction. And construction is actually just barely negative. Every other one is producing jobs, and 2 of them, education, health services, and professional business services, they're both producing an enormous amount of, or a significant amount of jobs. The overall growth rate is over 2%. That's better than any other place that I've seen in the nation. We're getting some growth along the coast, the California coast, but it's not this significant yet. So Texas is definitely leading the nation in terms of economic recovery, far better than it looked like a year ago, where job losses were evident. So the recovery is broad-based in Texas, in most Texas markets. I know that's not completely felt in the housing market yet. It takes about 12 to 24 month lead before it really filters to that housing market, but it is coming, where we'll see increased stability and even strength in some markets as the impact of job growth continues to filter into the housing market. It doesn't mean we'll see huge amounts of appreciation anytime soon. If you see our forecast in terms of appreciation, you can see it's fairly modest. This is what that appreciation looks like for the next 5 years, between 2 and 3.4% for the next 5 years. But it traditionally has been relatively modest in the Texas markets, especially now during a phase of increased regulation and the recovery from a horrific national recession. We think that dampens some of the appreciation in the future. Let's actually go back to our PowerPoint presentation for some closing comments. So, for those of you who are interested in getting a full review of what's going on in the Texas markets, feel free to contact my associates, either Judy Duell or Sandy Rivera. They'll give you a 1-month free trial to both the residential economic report as well as the housing transactions report. It means that you can go onto our website and pull that information for the Texas markets till your heart's content. We want it to be used, and we hope that you'll find use of it. Thank you for joining us for today's webinar. We hope you'll join us next week as we introduce another market and another topic. Thanks. Take care.